Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. If you haven't read the latest edition of the Saretsky Report, there is a link in the description below. Again, that is a large summarization of my thoughts and analysis on the Vancouver housing market. So if you want those in written format, again, there's a link below to the PDF, totally free to you. But I want to start this video off with some context to sort of base this around some comments made by Federal Reserve Chair Jay Powell. So let's clip to those now.
We just had a period of unemployment, as you know, that was in the well below 4%, hanging around 3.5%, that lasted 2 years. And during that period of time, we saw a lot of great things happening in the labor market, things that we'd love to get back to. We didn't see any problems with price inflation. Price inflation didn't really react much. So I would say, we'd be looking to get inflation back up, and we'd be prepared to tolerate pretty low, welcome, in fact, not tolerate, but welcome very low readings on unemployment, just based on what we saw in the last expansion. So, we're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time. I think most forecasters believe that. It would be great if we got a whole bunch more months of job creation like that. Notwithstanding that, as I mentioned, there are just a lot of people that are unemployed, and it seems quite likely that there'll be a significant group at the end of even after a lot of strong job growth that'll still be struggling to find jobs, and we'll still be providing strong accommodation for that.
As they say, Jay Powell says we're not even thinking about raising interest rates. So these guys are basically, interest rates increases are on hold until at least 2022 as per their indications. And again, as I've said in these videos numerous amounts of times, lower for longer, lower for longer, lower for longer. These guys are in what's called basically a debt trap. Where you have so much debt accumulation in the world in all sectors, whether that's through the household channel, through the corporate channel, or through the government channel, everybody's in this loaded up in mountains of debt where you cannot normalize interest rates. So you have to look at Japan and Europe as an example that basically we're in this lower for longer scheme, and this notion that, interest rates are going to normalize, yields are going to, shoot up, and this debt bubble is going to pop. We now have the Fed talking about yield curve control, which is essentially putting a cap on yields, on how much bond yields can increase. Basically, the Fed will incrementally buy bonds to essentially suppress rates from pushing higher. Again, so if you want to talk about free markets, again, those haven't been around for many, many years. So again, the bond market has essentially been nationalized, and we can talk about all the multitude of implications around that. I think this just means that capital has fewer places to flow into, bonds not being one of them. And so, that's, certainly you can make the argument for the stock market. I think you can make the argument for real assets, just as real estate and gold, for example. And which kind of brings me to my next point, is just really just watching the housing market very attentively right now. There seems to be a couple of trends emerging. One is a shift from condos into the detached housing segment. People wanting to get into larger places with the backyard. I think some of the behavioral shifts from COVID. Speaking of COVID, cases are actually at all-time highs right now, so you haven't really flattened the curve. I mean, you might have done it in certain parts of the world, but certainly COVID's still ripping, and this thing looks like it could get potentially out of hand with all these protests taking place and people packing streets, screaming at the top of their lungs and spewing this virus all over the place. You certainly have to feel for some of these businesses that were forced to shut down, that basically destroyed their businesses and it was all for nothing because people have totally ignored any notion of social distancing, and again, cases are ripping now to all-time highs. But circling back onto the housing demand side, it's interesting to sort of see what's happening, at least in parts of the world. In the U.S., there seems to be a strong rebound in housing. Again, I think taking advantage of the slightly lower interest rates, and some of that demand coming out of the spring market has now shifted into the summer market. You had mortgage purchase applications up a whopping 18% year over year. Redfin coming out with a lot of good analysis as well, basically showing a similar story to kind of what we're seeing in some parts of Canada here, is that there's really just a huge shortage of listings, that basically, the buyers that are showing up, there's very little inventory coming onto the market right now, but the inventory is starting to increase. It is starting to increase significantly, at least here in Vancouver. We had the number of new listings for the past week hit an all-time high for 2020. So all-time weekly high for 2020 across Greater Vancouver. Now, a lot of that inventory is being concentrated in the condo segment. I think that, again, this kind of skews more towards that investor base, that are a little more agnostic. If a vacancy frees up, and you don't know what you're going to be able to fill that rent for, you put it on the market. And so we're certainly seeing some compression in prices in the condo segment. Again, I have downtown Vancouver condo being the hardest hit market right now. Prices down anywhere from 5% to about 10%. And that's kind of where things are at right now. Yeah. So actually, full disclosure as we get into that, I actually just pulled the trigger myself on a one-bedroom condo with a couple of business partners. Again, I'm fairly bearish, but we managed to scoop up about a 15% discount below what would have been market value probably about 12 months ago. So again, a 15% decline. I'll take it. A little bit of a value add opportunity there as well. Do I believe that prices will fall further? Yeah, I think there's a very strong possibility. But again, I'm not going to sit here and try to time the bottom. I'm happy with my 15% discount. Have more capital to deploy should prices decline further, which again, I think that in certain segments of the market that they probably will. So I'm certainly readying cash for those opportunities as well. So again, teach their own. I'm sure I'll get a ton of comments in here about being a bag holder and a knife catcher, but that's kind of where it's at right now. And just attentively watching markets. I think there's a ton of things happening. We're seeing a lot of volatility in the stock market as well. And I want to keep this video shorter and a little bit more concise this week. Not a whole lot to discuss. Really, I think that the big story here is the inventory is starting to pick up. The listings are starting to increase. And as they start to normalize, and as we start to progress into this economic recovery, which I think is going to disappoint, and as these mortgage deferrals expire and these CERBs expire, I think that's when the true test of the resiliency of the housing market will come into play. So I think if you're looking for that picture, that story, it's going to be in the fall and the winter, particularly if COVID starts to rip higher. So I think that's something to really, really keep an eye on. And so not much has changed in that aspect. That's kind of where things stand today. But hope that brought you some value. If it did, hit thumbs up, subscribe, and we'll see you next week.